Lead a life of entrepreneurial freedom with insights from successful creatives, entrepreneurs, and investors. Discover how they overcame challenges and turned their biggest dreams into reality. They share their personal success playbook so you can build the business and life you truly want. Welcome to Passion Millionaire, the podcast by Robert Roth. Rock and roll your dreams.
Welcome to today's episode of the Passion Millionaire Podcast with Karen Rands. We have met on LinkedIn and I'm super excited about her expertise. She's been in this specific field of investment since several years, many years. You're going to go in all the details. And she's a leader of the compassionate capitalist movement. She's a best-selling author, podcaster, and basically her mission is helping entrepreneurs finding the right type of capital. And as we have entrepreneurs listening here, I am curious to learn as much as possible from you, Karen. So I'm glad you're here. Thanks for taking the time. Welcome, Karen Rands.
Thank you so very much, Robert. I'm delighted to be a part of it. I mean, you talk about the name of your show, The Passionate Millionaire. That's like right up my alley. So this is great to be a part of this. And it has been, I have been involved in angel investing and entrepreneurs raising capital and all the types of, and crowdfund investing for now over 20 years, probably going, about 25 years, something like that, so and my knowledge and experience and passion for it itself has evolved over those years and understanding why there's more companies than investors, why more people are encouraged to become entrepreneurs as a way to create financial independence versus becoming an investor. And, in unpacking that and trying to working to demystify it, to create awareness, provide the tools and the education so that those folks that don't have a clear path to what it is that they want to do as an entrepreneur and a clear path to how they're going to scale. They just, have this sense like, oh, I got to be an entrepreneur, but they don't really know how they're doing it. It's really, really hard. It's not something that you just sort of jump in the deep end and just start figuring it out like, oh, I forgot I didn't know how to swim. And so this is like, you need to, and if it's not there, you not willing to take the time to figure out if whatever you're thinking about doing is really good to do, is a good product market fit, then think about taking all the money that you yourself would have to put in to just get started and instead put it in 5, 10, 15 different companies and fuel their growth so that you can share in their success. Because every tech billionaire you ever heard of did it on the shoulders of literally thousands of folks, probably hundreds of them became millionaires when that tech billionaire became a billionaire,
Right. Oh, that's very exciting. I'd be super curious. I mean, 20 years plus of experience in that field. I mean, that's pretty overwhelming. And I'm sure things have changed also over time. So especially I'd be curious, what are the things that work right now? And especially who are those things working for usually? So I would love to hear from you, typically from what you see personally in your work, and what type of companies actually really deserve to receive capital, and who usually deserves to be an investor for those companies that have a high chance to become more and more successful.
Okay, well, so there's the deserve word in there is kind of interesting depending on because I believe that everybody that has liquidity, has any disposable income, has been frustrated by the at least in the United States, can't speak to it everywhere else, but I'm pretty certain it's probably similar. In the United States, we have a very inflated real estate market. So the average person doesn't have the ability to invest in real estate like they used to be able to. And we also learned a long time ago that, in the Great Recession, that if you own your properties with a bank, you don't actually own them. And what you've been doing is just paying a bunch of money to a bank that you could just get wiped out, not that difficult if you get a bad tenant or something bad happens, or what's happened here in the U.S. is, taxes and insurance go up, and it causes your mortgage payment to go up, and you can find yourself underwater on your tenant. So it's like, so a lot of things, stock market's volatile, not even you can't even predict why a stock goes down or up anymore. There's not, sometimes it's their reports, but a lot of times this factor is completely outside the control of the investor. And so people looking for a different way to put their money to work and wanting to put their money to work with impact. So the key change in all of that, because to me, that's what a compassionate capitalist is, right? When I first met the first angel investors I ever met 20 something years ago, and started to understand how they became angel investors, I realized they're wealthy. They could invest in anything, but they chose to put a portion of their income, their wealth, into entrepreneurs. And the reason why they did that, besides being a capitalist and wanting to make money, they were a capitalist. That's how they made the money that they could use to invest in entrepreneurs, right? But they wanted to solve problems with their money. They wanted to have impact with their money. They wanted to see innovation and technology move forward, right? I mean, we take VR's headsets for granted now, but that technology has actually been being invested in for like probably at this point 35 or 40 years, right? And so,
Oh,
to
wow.
think that we have the commercial versions of what we have now. So and you think about like every major innovation that we become accustomed to, and like I joke, right? So now we have these phones that do everything for us, right? They're like a supercomputer in this little thing you can hold in your hand that, you know, uh, however many, 60, 70 years ago would fill a room, right?
Right.
And then and like back when I was first doing my videos, tips for entrepreneurs, I had these, it was I did these little videos with a thing called a flip camera. So I
Hmm.
just aged myself a little bit, right? Because we didn't have cell phones with cameras back then.
Yep.
If you had a cell phone, most mobile phones, if you go back to the old, like some of the old 70s shows, and you have these things that look like suitcases, right? That you carry around, that was your mobile phone, right? You see some of those videos, that you have, right? Or then we got flip phones. I remember when I got my first flip phone, I was like, ooh, I was so cool because I had this little flip phone. But they had no camera capability, and we had something else. And now we completely take it for granted. Part of the reason why we buy a phone is how good is the camera and the video in it to do the things we do for content creation. So, evolution of technology is because people invested in it before, but because banks don't invest in it, right? So I never knew when I first was at IBM, when I left, that there was this secret society of angel investors that were between an idea and when somebody was bankable or VCable. They were like
Yep.
this group that would get to pick and choose what to invest in.
Hmm.
And so to that deserve thing, at the time when I was running my angel investment group, and one of the things that was frustrating to me, that sort of fueled where I am today, is because it was, and you watch Shark Tank, everybody watched Shark
Yeah,
Tank or
for
Dragon
sure.
Den or anything like that. There's 3 companies or 4 companies. It's what is allowable in this hour segment. And there's also an entertainment value because they need the viewers. They make money by
Yep.
selling advertising, and so they need viewers, so they have to be entertaining. And so, and when I was putting on my angel investor events, they were entertaining. I wanted the investors to come back. They had to be legit companies that had potential to make money, because if they were dog companies, they're not going to come back, right? I had to have a reputation of a good company. But
Okay.
along the
Yep.
way, the 3 that got picked or the 4 that got picked to present, there were 2 or 3 others that were probably just as good, but they didn't have. I couldn't have 2. I was our group was very eclectic, so I didn't have just all of one type of industry. So I wouldn't want to have 2 medical industries or 2 software companies in there. They had to be different, right? And you had some meat and potato kind of companies that you don't really think about, so they had to, right? But then, so the whole nature
Let
of
me
it,
ask you about it. Why did they have to be different?
because they're competing with each other for capital. And so if you got somebody in the room that wants to, that it like their number one area is biotech or biomed, and there's 2 companies, they're competing with that one. But what I found is that somebody that says they're a biomed, if they see, or let me use it as a different example because this has happened. Um, they only do software. Let's say they only do software.
Yep.
And we had a company one time that was it was a hospital bed that, because our bodies produce electric signals, right? Our body produce electric signals. So it would pick it up wirelessly, our electric signals, so without having to have wires and stuff on you, could take your vitals and have all your vitals to be able to inform the nurse of what your breathing was, what your heartbeat was, all that stuff without you being pinned and pricked and all those kind of things. And it was this pretty and it was a pretty amazing technology, right? So software investors would, like, they saw that and they saw the potential of where it could go. So the capitalist side of the passion part of it is this. Oh, I like software and I'm passionate about solving whatever. But the capitalist side kicks in if a company just knows their product market fit, knows how they're going to generate revenue, knows how they're going to get there and get a return on investment. And from that, they become deserving of the money, right? So every entrepreneur that goes through the gauntlet of figuring out how to check the boxes of what makes it an investable company can get the capital in that traditional sense. The beauty of the Jobs Act and the rise of equity crowdfunding is that if somebody was like this idea, if somebody was, it was really, really, really hard, and it still is hard for consumer products companies to get capital from angel investors.
Okay. Yeah.
Because of the nature that there's more cost. Anything that has to be manufactured has more cost associated with it. And if it's in a space that's crowded where it's hard to, like, let's say children's toys, right? How do you get shelf space and get the eyes and minds of your potential customer when there's lots of children's toys out there? So it takes a marketing dollar investment as well,
right.
maybe more. So there's this. So people, they judge that because then they look at, scalability and all those kind of things. And so whereas crowdfunding has helped companies overcome that and get to a point that they can prove scalability so they can qualify for traditional angels. And likewise, companies that may have raised angel money and they kind of plateaued because they didn't anticipate when they were going to need their second round of capital, and they didn't start trying to raise it in a good time. And so they missed the VC boat. The train left the station. And so a lot of times they sit in angel portfolios just sort of flat, just kind of coasting along because they can't get the capital they need to bring another product out or do something else. Well, crowdfunding, Reg A Plus, and 506C are perfect strategies for a company to be able to raise that extra round to go do that next thing and get back on their scale life cycle. And in all of those cases, you have to, whenever you do crowdfunding, you have to, as raising capital, you have to be even more deserving, if you will, because you don't have the value of sitting across the table and convincing someone, right? And that because it's done through a digital, platform. So it's the
That's
relationships,
crowdfunding, right?
and all the different kind of crowdfunding. And so, there, to me, and the other side of the democratization of capital markets on the deserve side is that, so many people were excluded from the ability to invest in entrepreneurs up until 2012 and really 2015 when they all started to happen. And so now anybody can invest in entrepreneurs. And so even if it's like one of my big pushes is community-based finance, so that a business that wants to open up a second location can raise money from their customers. They become their investors, and they love them, right? The people that love you get to invest in you, and there's no, there's no restriction on who can go to Vegas and throw $20,000 on the crap tables.
Yeah, right. So
Right?
you're talking about accredited investors and non-accredited investors right now?
Right.
Or is it something-
Anybody
okay,
can play. And the only limit, like on crypto and stocks, is 18 years old. But we had all these restrictions on it when it came to investing in entrepreneurs. And so now it's a level playing field with the other asset classes that you can play. I mean, there's still some restrictions and bogus restrictions on income, but that's being dealt with. So anyway, that was a long, rounded way to
Yeah.
answer your question, but it is both sides of the equation, and it's an exciting time because anybody can raise capital from anybody if they just follow the pathways.
Yeah, got it. Thank you very much for that. That's also a great answer to my question because it had those both sides. And I'd be super curious. I mean, um, it has a lot to do with innovation. I hear when you're speaking, at least the projects that you have your hands in there. And then I'd be curious, what would be a typical case that you would take on as a company, and then finding the right investors for, and how would that case come together?
So part of what I do when companies reach out to me to get a capital strategy or to talk about, raising capital, I have to go through would I invest in them. Now, I'm not actively investing now because all of my extra money goes into building my digital platform, my own business, right? And so that's what but I do if I really because part of it is it costs money to raise capital. And so I look for shared risk. So what I do defer some of my fees and I take equity.
Mhm.
So part of that is that I believe that they have the ability to raise capital, so they have all the things that I think will keep them from flatlining, and therefore, it's worth. I have two ways. I can work just their people, and I don't take them to any of my people because they just want my help and they don't know how to raise capital. And that's one way. And then when I just deem that they're worthy and they've done the work and they're scalable, they got the right value proposition, they got the right terms, then I will start working to take them to my investors. So in point in case point I worked with this company year and a half ago because one of a founder in a company that my investor group had put a few $1 million in that had developed a non-allergenic latex. And
Okay.
when he left that company, he became an angel investor. And so and
Interesting.
advising some people. So he ended up going into this company. When they started to struggle raising capital, he reached out to me.
Hmm.
So they'd raised almost $1 million from friends and family because of the credibility of the founder and the concept of what they were doing. So
Yeah.
it is a software package that when they first went to market was for police officers and anybody that was in security to be able to, in an incident where they had to use force, document all of the situation, what they would do, because there's always going to be an investigation and something like that.
Yeah.
And they would document it so that they would give us, because the nature of how people, when you're in a very stressful situation like that, you forget a lot of stuff, right? And your adrenaline's flowing and, all this kind of stuff. And you don't really know all the reasons, all the factors that all your senses took in when you decided to take the action that you to take it to defend yourself. And so, but the problem was he was really good because he was in that industry and he could raise money in that industry and he sold some products in that industry, but it wasn't a very large industry compared to the individual civilians, regular consumers that have the same need. We in the United States, we have a lot of gun owners and we have a lot of situations where even anything, like all kinds of examples where somebody, because you get into a fight, you're defending your life or your loved one because somebody's attacking you, and you pick up a rock, right? But as soon as the police arrive, whoever's most injured becomes the victim, and the other person gets investigated,
Yeah. Yeah.
right? And so if you were defending yourself, you got to be able to do that. So they had a bad valuation, they had bad terms, they had no real financial forecast in the original version of this. They were just a mess. And so they spent a good bit of time. They did not know how to do their financial forecast. They were really they just were a mess. So
Okay.
and so then they went off and fixed it with my advice. I gave them a blueprint. This is what you got to do. So it took them about a year. They had to restructure their cap table. They ended up having made a big mistake on their IP that they had to fix, which
Oh,
they
okay.
did. And
Yep.
they fixed their cap table. They fixed their valuation. They they pivoted to a consumer product. They formed major strategic alliances with huge organizations that want to sell it to their members. So the day
Oh
they go
wow.
into the market, they will have thousands and thousands of people using the product or subscribing to the product, right?
Hmm.
They've got a celebrity spokesperson, and the core product works. It just needs a little interface to make it consumer driven versus, police officer driven, right? So
Yeah.
it's a different way that you ask the questions, and a little bit different interface on it. So, they came back, and we have been working it, and it is and and he's more confident. He was not your classic CEO. He was, at the time, he was afraid of questions. Now he's like, like he's like he's in it. You know what I mean? And
All
so
right.
they evolved, they pivoted, they evolved, and now they're capital ready. They're ready to raise capital and scale. I'm very excited about them. I'd like talking about them, and that's the difference, right? They're
That's
paying me to
interesting.
take
Uh,
money. It's just the
yeah.
difference of who I take them to.
Yeah, and I would love to zoom in on one detail here a little bit. Because if I got you right in the beginning, okay, there was this idea of the software or maybe something going, but then they raised about 1 million from friends and family, right? And
Yeah.
then they came to you at some point and you helped them get ready for more capital. And in between those, was there an additional capital injection happen after this first million, or was it just restructuring and advice that they have taken for that?
Yeah. So, no, at that time, they wouldn't believe me sometimes that they needed to do some stuff. They weren't really believing me.
Hmm.
So I went and got friends of mine that run angel groups to look at their deer and get on the phone and tell them why they were not going to invest in what was a problem for
Hmm.
them, which is what I was saying. So I just got people. I was like, okay, hey, I'm working with this company. I want you to take a look at it. I want you to be honest, 'cause I think it would be good for your group if they were right. But they got all these are all the things that are wrong with them,
Hmm.
right? Like they didn't have a team. They didn't have a technologist on their team, right? They're a technology company. They had no technologist,
Wow,
right?
that's
Now they do.
interesting. How did that work out?
Okay. Well, that's how they
Yeah.
made their IP mistake, because they
Yeah.
hired a software firm, and
Oh,
it's
the software firm owned the IP or what?
just a little something like that. Yeah, they
Oh,
did. Yeah, so
that's
they did.
adventurous.
Yeah, and they figured it out. Yeah, so there was this. It was this. They had gotten some investment banker to do their financials, and
Mhm.
they they assumed, the same organization that is now taking them to their thing, that they would pay them $100 for it. I mean, like, their membership's only $100. They're not gonna pay you
Yeah.
$100
Wow.
to add that. You have to really, and it's a software, right? And
Yeah.
so, they just I go, "You gotta get to a one-on-many. If you're gonna ever do this, it has to be a one-on-many. You can't sell this police department, this police department, this police
Mhm.
department. You gotta be a one-on-many." And they didn't really understand what they meant. I said, "You gotta have a funnel. What's your funnel? What's a funnel?" Right? I mean, they were like they were industry specialists, but really did not have the business sense that they have now. They have that now. They went off for a year and figure a bunch of stuff out till they came back to me. And
Mhm.
then they came back to me, and I told them how to redo their cap table. I gave them all the instructions on how to. I go, I'm not a lawyer. You need to go get a lawyer like this, but this is fundamentally what you do. This is the communication you need to say to your investors. This is what you need to do to be able to save face and keep them all engaged, and maybe even reinvest when you get into this new pivoted model. And so they have done all that, and now they listen to everything I say. So
Which makes sense. Wow, that's quite an interesting story. So when you're saying they're ready for more capital, are they now looking for capital or have they
yeah,
already received
so
additional capital?
they get a new round. It's a new number. The other one is one. It's
So the
the
first
this
round was
the
seed, now it's
pre-seed.
Series A, I assume.
No, this would be. We're still calling it a seed round because they don't
Okay.
have this new version. This money goes into making the new version, but their threshold for that is only like 200K, and then the rest is, they understand, like, their first round of financials, they had this huge revenue thing, but they were going to be let's just, I don't remember what the number was, but we'll just say $100 million company, and they still had the same 6 people running it. And it's like, name a
Wow.
$100 million company that is run with 6 people. You need
Yep.
customer support. We're going to need tech people. You're going to need salespeople, people that answer the phones for like when they call in, they got a problem. You're going to have all these other people.
Hmm.
And if you don't have like, there's no business out there that gets to 100 million with 6 people off of only raising $2 million. That's the thing you got to
Hmm.
understand too, right? Now they understand that, so now they have all that factored in, right? And so
Yeah.
it's just, it's like, things like that they just don't. The entrepreneurs don't know what they don't know until somebody tells them, and then
Right.
they don't, because it's so new to them. They may not be wanting to be like, "Oh
Hmm.
gosh, I didn't know that, and now I know it, so I'm gonna do it." They challenge it because it challenges their paradigms of what they think or what they're doing until they hear from other sources, or they live it, right? They feel it, they live the
Hmm.
experience. And, hats off to the CEO that didn't give up, because he was pretty like deflated by the whole experience.
Hmm.
And he was willing to, suck it up, take the advice, listen, and shift his mindset to a much different mindset.
Hmm.
And now yeah, I mean, it's not right. Yeah, end of the year is not a good time to raise capital, but I feel for certain we'll probably close on 100,000 of his people's money, and be in a position of negotiating with bigger money from a couple of people I brought in January. So
Hmm.
it's moving.
Wow, that sounds really exciting. I'm happy to hear that. I'd be curious also, like, how do you usually find those entrepreneurs, and on the other hand, those angel investors, or how do they find you?
So the entrepreneurs, being found by entrepreneurs isn't as hard as, that, because they're looking for people
Yeah.
because I have all this
Yeah.
angel investor stuff around my branding. So a lot of times they come to me thinking I'm actively angel. And if they read my LinkedIn profile, they would know I'm not actively investing, but they come to me with that. So when they go, I'll say, well, here's the thing. I'm not actively investing. I'm happy to get on a call with you and help you figure out what you need to do if you're struggling to raise capital. I'm the person you come to when you're tired of you want more yeses than nos. And so that's, and so sometimes people have to bang their head on a wall for a little bit. They won't. I mean, like, I had a lady talk to me the day, and I just saw the headline. If I could remember who she was, I'd send her the thing. She reached out to me because she wanted to create a teddy bear that had AI in it to be able to talk to you, right?
Okay.
And she had this big elaborate strategy of how she was going to do that. I'm like, I think there's people doing that right now. Have you done like your research on that?
Hmm.
And she's like, "Oh, no," like, she, like, was really very, very like, had blinders on to the market, and she was, like, on the call hugging a teddy bear, and like,
Yeah.
"Oh, this is how make you feel. It's like a care pet," and people, and all this kind of stuff. And then I saw a headline today about these teddy bears with AI that they find are, like, talking pornography to the kid, or how to light a match, or how to, do these things that parents don't want their kids to know, right? And so,
That's right.
and it's like, and so, but she was like, "Well, I just got to find one person that shares my vision." I'm like, "Good luck with that," right? And see, so there's, they find you, but so till they, that's that piece of it. And, because of my own podcast, because of my background, I'm running an angel group for a decade.
Hmm.
I know a lot of angels. And so I resurrect relationships with the angel groups that we used to syndicate with. I mean, one thing I had to do, and part of the reason why I had the training and bringing out new angels, is that when I sunset my angel group, most of the angels in my group were like a decade older than me. And I probably spent a decade not doing any of that stuff. And when I came back in, decided to resurrect everything, I realized that they were all still a decade older than me. And so a lot of them were not actively investing anymore. They were like working to wait for their exits and just mentoring, things like that, being on boards and stuff like that, and not actively investing. So I had to attract 45-year-olds instead of, the 65-year-olds, right?
Yeah.
And so it was, so that was, so when I came out with the first book, Inside Secrets to Angel Investing, the intention of that was to help this people that executives in companies that were accredited investors that weren't actively in angels either because
Uh-huh.
of location or time would begin to understand it and know whether they could and get involved in funds or different things, and also because crowdfunding had happened.
Mhm.
I rapidly learned that people didn't look for the term angel. I mean, you can't find a book on angel investing if you're not looking for a book on angel investing. Like if you don't even
Yeah.
know that term, right? So I was really focused. There's a lot, like in Atlanta itself, we have a lot of incubators. There's a lot of resources for startups. Startups don't need to pay me for my expertise when they can go to an incubator or an accelerator and get that, and get access to angels that come and circle through that and stuff like that. So I'm the one that solves the problem when they've done their seed round and they need, like I spoke about earlier, they go and they don't know how to raise the next round of capital and they can't go to VCs. Where do they go? So those are the ones. This guy's a startup, and he came to me because of this angel investor is in it that had been part of my community, and they came to me, right? And so other ones just sort of find me because they've known of me for a long time and they see I'm out there. I have another company that I'm kind of working with that has an AI solution for the hospitality sector,
Okay.
and has traction, has good, but they're really it's really complicated, and they're not, in my opinion, approaching their the capital strategy correctly, and so they've not been successful in raising capital, but they haven't gotten broken enough to be like, okay, Karen, we're going to do it your way. So, I'm not actively going out to my investors for them because
Yeah, I
I know,
hear you.
I mean,
Mm.
I talked to a VC at this event, Adventure Atlanta, and I said, this is what the problem is. If you can see the value of what they're doing and be willing to work through the fact they don't have a term sheet, they don't have an
Oh,
offering, which is one of
yeah.
the first things you need to have. They don't have a cap table, right? The founder owns everything, even though he's promised shares to a bunch of people in the
Mhm.
company. And so those three things are stopgaps. You will not pass due diligence unless somebody's really motivated with your solution that is willing to help you build that as the first investor,
Mhm.
which is another level of magnitude of commitment that some investors don't want. They just want to know what the terms are and I can make a decision. And so those are some of the fundamentals. And so, those are the things that I have found that if those are the kind of companies that I can best serve,
Mhm.
unless they are tired of getting no's. They're not actively in a community where there's a lot of investors that they can bump elbows with and, stumble upon that. And that's so I'm the problem. So I'm the angel whisperer, I
I
guess.
hear you. I'm really glad that you said that. What needs to be in place for a startup looking for capital? Because whoever just heard that, it makes sense to get that in place. Ideally, even before getting in touch with you, Karen. Right? So then you have a much easier job. They have a much better chance to achieve something. By the
Yeah.
way, I just literally a minute ago ordered your book on Amazon, Karen. So I
Yay.
assume this and more information would be um, in there for startups. And if somebody reads your book before, hit me up. Probably also a bonus, I assume. Is there
Yeah.
also information, for the angel side that you would love that they already knew before they got in contact with you?
For angel investors,
Yep.
um, my book. So I talked about the first book. My second book is different. The one that just came out. Did you get the first one, Inside Secrets to Angel
The
Investing?
second one I just got, but I saw there were two. I thought the second one is kind of a new version of the first one, but it's
Yeah,
not. I
no,
almost
so, yeah,
thought
the
too.
first one,
Confident. Yeah.
this one is a deep, dense book, Inside Secrets to Angel Investing. It is, a how-to step-by-step. It has step points. It has, it's a business book.
Yeah.
This new one well, you can see it because here, the new one is more of a story and geared directly towards crowdfunding, getting started as a crowdfunding
Yeah.
investor, building
Okay.
it.
Now I bought the second one too.
Okay.
So I
Building
got
into
like
your
both.
confidence to become an angel and like an accredited investor. And so
Hmm.
one of the questions that came up last night is like, well, how do you start? So the very
Yeah.
first thing that an investor needs to do, and so this is kind of what the first decision that an angel investor needs to make, and any kind of investor that's investing in entrepreneurs,
Hmm.
you've got to decide, you've got to commit emotionally, psychologically, financially to making at least 10 investments over 2 to 3 years.
Hmm.
Okay. At the most 5 years,
Hmm.
depending on how much time you're willing to put in it, if you're in a part of an angel group, speed of which, but really, and so part of that is figuring out how much money you have on hand to invest. And do you have something that every year is going to give you excess capital or your way that you spend your money, you always have excess liquidity that you can continue to invest in more companies. If you have a bonus that you get every year because you're an executive in a company, you could allocate that bonus towards what you're going to do for angel investing. And maybe it's a 50K bonus. So you might decide you're going to do 10K in 5 companies, 25K in 2 companies, whatever it's going to be, right? You might vary 10 companies in this one, 20 and 20, and so you would do 3 that year. So you could do 3. The kiss of
Yeah.
death of an angel investor getting started is do only 3. And anytime somebody comes into what they found sort of like if somebody sells a company, they make a bunch of money, they're like, they get invited to an angel group. They're like, yeah, this sounds cool. It'd be good to be an angel. And I am. Um, and they'll invest in 3 because it's easy to do 3 in a year if you're in an angel group. And
Mhm.
then they'll be like, okay, let me see what happens.
So what would be the total amount of capital typically? Like, I mean, the bottom and then the top for an angel that will be starting with you, for example?
Well, okay. So an angel that a lot of angel groups have a minimum investment of 10,000 in a year, and they'll
Yeah, so
break
that's
that in
very low,
because
literally. Yeah.
yeah, well,
Mhm.
that is because if you tell people that you can't be a part of my group unless you're going to commit to 25K or 50K, the national average of the amount an individual angel writes is 25K.
What?
So, but
That's okay. I'm surprised how low that is.
yeah, well, that's where they put because they're doing it in multiple companies, right? Because you're gonna do so they might be putting 100K to work that year, but they're gonna do it in 4 companies that they invest in the group, and the angel group may put 500,000 into a company, and the angel put 25K of that 500,000, right?
Mhm.
And that's just really part of the diversification because you know, you do have the super millionaires out there that, they usually end up starting a VC fund, right? Or they participate in a fund and they'll do 100K into a company.
Mhm.
But usually that's after they have dabbled. I mean, I call it the West Coast strategy where angels they'll put a little bit of money into a bunch of companies.
Mhm.
So they see which ones like that are at that pre-seed stage. They might put, okay, I'm going to give you 10K, 5 of them give 10K. So it's 50K goes into this thing. We're going to see what you do with it. And they'll do that with 5 companies
Right.
or something. And then those 5 companies that get to the next level, that they get a product out, they get customers, they show they can scale, they get the 25K. So now they've got 125K or 250K from that group of angels. And then the next thing they put 50K in and they get so there'll be, 85 all in, but they did it as the company hit different milestones
Yep.
that they were going through so that they don't put 85K in it at the beginning. That's all at risk, right? And so so the first thing is figuring out how much money that you have. And so crowdfunding folks, the accredited adjacent that I'm teaching with the second book, they might have because if you're not accredited, you're limited in that the max you can put into a company is 2,000 and 10,000 in a year.
Oh, okay.
Okay, so for the unaccredited, so Reg C, people that do Reg CF, Reg A plus, okay, or interstate exemption.
Mhm.
And so they are going to put, and that's where it's kind of funky on like it's an income thing. If you had more money, you wanted to put more of it at risk. Why are you limiting it that? And they don't really. It's just a very gray area in how they do that. So it's and so you figure out how much for this, and then you got to figure out what is it that you know about, like the Buffett
Mhm.
model. So you invest in what you know, and so people. and thinking beyond, earned and learned experience. So you go to school, you get your technology degree, let's say, like, a software engineer. So I know software, but your hobbies are like, oh, I love to do water sports.
Mhm.
And so you know about that industry, and if you saw a product in the industry, go like, God, I can't believe they finally invented that product, or like you're a piano player or something in music, right? I remember the guy on Shark Tank that had the foldable guitar that it
Yeah,
was
right.
easy to
Yeah.
travel, and they spit all over it. They didn't like it. Well, he went off just because the notoriety got there, and he became like quite sizable, right? And then I
Mhm.
think some of them came back and invested in it. He did well as a result of that. But that would be something in an industry because of your hobbies or things you're interested in. You watch all the science shows, and so things like that. So you grade yourself on that, and then the third thing. So then because I teach people to take it through a filter to try to eliminate the emotional side of their investments,
Mhm.
because that's sort of this other kiss of death, only investing in three or not building a diverse portfolio, and then investing on emotion. And every angel has invested on emotion. I mean, every angel that has been doing it a while has this hidden checklist this is what I teach entrepreneurs, that like, because I take them through that filter. I call the red flags, and they got a red flag like, God, I should have known better. Never doing that again, right?
Uh-huh.
Because let their emotion get ahead of them, and they wanted to see that entrepreneur succeed because they're charismatic, or they wanted to see that product succeed. You know, that was the case of the first one I talked about, the non-allergenic latex.
Mhm.
They came to me because they had raised $2 million from doctors and were stuck and couldn't raise any more money,
Oh, wow.
and they needed to raise more money because their valuation was way off and their terms were way off. And they came to me, and I said, and to my angel group, I said, well, you're going to have to change this. People will like, but you're going to have to change it. So I to help them figure out how to restructure to do this. And because doctors are notorious for investing in emotion, they knew the value of a non-allergenic latex. They had no concept of how difficult it would be to get it to market and into the hospital room, right?
Mhm.
They just wanted to see it in the hospital room, and so they were willing to put money into this thing. But all the other investors are like, well, how are you going to get it into the hospital room, right? I mean, we could see that, but and so they had to, and so we restructured it. So instead of doing a down round, which would be bad, like this, we offered a sweetener of stock options.
Mhm.
So in effect, if they executed the stock options, it turned the price to half the value. They were like, say it was $2 a share, it made it $1 a share
Okay.
if they exercised the options. But they didn't have to, which if they did would be more money into the company. But
Mhm.
psychologically, to the investors, they were like, oh my God, I'm getting a deal. And we put a deadline on it because people work against deadline. And this is back when
Yeah.
fax machines were something that people really used. And so they were like calling me saying, if I fax my thing in, I can't, the banks won't let me put my money in until Monday, wire it until Monday,
Wow.
right? We didn't have 24-hour digital banking. And it was like, how do I can't, will they still let me get the deal? And I'm
Mhm.
like, yeah, I think so, you know?
Nice.
We just created this deadline to
Yeah.
create an emergency. And
Nice
so,
story.
that's me solving the problem of no's into yeses, right?
Mhm.
And so so figuring out and then figuring out the problems you want to see solved
Mhm.
so that you focus on, because there's a gazillion entrepreneurs looking, not actually, but a lot of entrepreneurs looking for opportunities, and a lot of them are really, really compelling, and you can be overwhelmed with the opportunities you have to invest in if you don't get clarity on yourself of what are you passionate about, what
Yeah,
problem
right. And
you want to see solved. I mean, you were talking about
yep.
the company in Utah, that's something that you're passionate about, right? So,
Mhm. Yeah, and I'd be
that
curious, because maybe that's a last question also for this podcast, and I think that will be a good place also for this question and especially your answer. Because if you think back all the experience that you have, and now basically let's think out of the investor perspective, which we were just hopping on again. I'd be
yeah.
curious, what would be the number one advice for an investor to look at before making an investment in order to increase the chances to succeed with the money you've just put in?
I am a real big believer in the financials. The financials tell the story. Okay. I tell you, the financials are the real meat of what this company it knows that they can do.
Hmm.
Okay. And that is otherwise if they're you can tell if they're guessing.
Hmm.
And so if they're guessing, that means they have to figure it out on your dime. And sometimes it takes a lot more money than they think to figure the stuff out if they haven't figured it out by the time they come asking you for money. And so the financials, to me, the financials tell the story. The business plan is the narrative of the financials of how they're going to execute on to get those numbers. And the pitch deck is it's visualization of the business plan of how you're going to execute to get to those numbers, right? So if they don't know the true cost of goods, they don't know what their sales cycle is, how long is it going to take people to make the difference between a consumer product and an enterprise software product, right? If they don't really understand, how are they going to sell it? And so they underestimate the resources they need, the time it takes 6 months to sell this $10,000 software product, or it takes X amount of touches into their social feeds to be able to sell this $9.99 software product, whatever it is. Every business has a different business model. And if they don't really understand that, they don't really, and then their numbers will be off. And you can always tell because there's no seasonality in it, because we know there is always seasonality in any business. And so if you see something that looks pretty even and clean and stuff like that, then that means that they're doing it on a percentage of. They don't really understand their marketplace and the seasonality of where they're going to have and why, and that's where the need for capital comes from, because there's always an ebb and flow where you're bridging the gap until your revenue catches up to you to pay for the things you need to pay. You have to pay for things to generate that revenue. And if they don't really understand that, that's where they run out of money. And that's where your risk comes, because if they can't get the money to continue to scale to get to an exit, then they don't exit and you don't get your return on investment.
That makes so much sense. I appreciate you explaining this. And wow, Karen, thank you so much for, again, one more time, for taking your time to be here. And wow, that was a flood of information, which I'm super excited about. And I'm even more excited about reading your books because you got me going here. I love it.
Terrific.
And for anybody who would love to get in contact with you, we know there are prerequisites. Listen back to the podcast now. What would be the best way to reach out to you?
Well, you know what? I mean, my website is cougaran.com or karenrands.co. So Cougaran is my company's name is Cougaran Capital Holdings. Sounds like gold, but not spelled like the gold coin. It's Kugarand, right? And so in there is my contact page. You can get there's an opt-in to get a ebook and stuff like that. Or if they go to, and put this I'll make sure you have this for your show notes, but it's bit.ly link
No, you can just send me the link. I'll put
I'll
it down
send
there.
it. It's a link tree. My link tree has everything. Links to the books, links to my podcast, links to set an appointment, right? All of that stuff is in my link tree. And
Excellent.
it's link CCS Compassionate Capitalist Show is what I think it is, bit.ly link, but we'll give that to you and it'll be
Please.
down in the show notes and people can grab that. But
Absolutely. Karen, thanks for that. And everybody who wants to reach out, now you know how to do it. You find it in the show notes, also in the podcast. Feel free to reach out to Karen. I'd be excited if something would happen also. And
yeah, I'd love it. To be like, oh man, I was listening to you on Robert's podcast. And I had to go down
Why not?
that's why we do this, right? No trust buy.
Why not? Karen, thanks again. I'm glad you were here. See you soon. All the best.
Thank you so much.
Cheers.
Thank you so much. Bye-bye.
Go to rockandrollyourdreams.com/podcast.